Not all savings environments are created equal. Some give you one or two benefits, but are you maximizing all the benefits that you deserve with where you save and hold your cash reserves? I'm Kyle, and I help people build financial systems and models around the world of banking, tough money, and generational wealth. And in this video, I want to break down one of the most intentional places you can store and keep your cash reserves, your liquidity, your savings, in an environment that's going to help you bring so many wonderful benefits to your wealth plan. So with that, let's jump right in and talk about this savings environment. Now, this is in addition to our path of money conversation and framework that we use so frequently. And, understanding how money moves through our life is so important. There's really only four things we can do with it. We can spend money, we can donate it. The rest is called savings. And the environment in which you hold your money there in this green box will make such a remarkably big impact on your wealth plan over time. But we have to have the right places to store and make sure that we're getting all the benefits that we deserve. And in order to really appreciate, I think, one of the toughest foundational assets you'll ever own, we have to be able to answer what I would consider to be some of the most important financial questions you'll ever be asked. Specifically, question 4 of the 5 most important questions, which is, do you know if the current environment where you hold your money is maximizing the benefits you deserve? Now, inside our Tough Money workbook, you're going to find an entire few worksheets in this workbook that help you go really deep and get a lot of clarity and perspective on where's my cash position now, what are the different environments, and am I maximizing all the benefits that I deserve? Now, when we talk about savings strategies, savings environments, one is a habit and one is a location. So when it comes to just the environment that we're going to hold money in, we have to get very intentional with what is the criteria for storing liquid assets. Now, key word here is liquid assets. Anytime you're talking about a savings environment, this is not going to be equity in a home, retirement accounts, stocks. This money has to be so safe. That's one of the criteria. And it's got to be very liquid or accessible. So I'm talking like 2 weeks, 3 weeks at most. You can get access to this money very quickly. Typically no questions asked. So if your money has any type of like locks or penalties or anything like that, I would be careful to call that a liquid safe asset. So some of the ones we've identified here in our Tough Money workbook are some of the most popular locations. I'm not saying this is all of them, but these are probably the most common places Americans are storing cash. So when you want to go through this exercise, how you want to do this is start to figure out, where am I holding my current liquid assets? You might have $15,000 in a savings account. You might keep $2,000 in actual cash under your mattress or in your safe at home. You might have $3,000 of precious metals. Maybe you have some treasuries or bonds. Sometimes we see those, sometimes we don't. Maybe you have life insurance cash values. We are going to spend some time talking about that today. And maybe you have $5,000 in an 18-month CD. So all of these assets on the left side of the screen would be considered liquid and safe. So these would qualify as a savings environment. And that is the purpose of having this money, is first and foremost to protect yourself and save you in time of need. But what's interesting about this is the bigger your liquidity buffer gets, or your cash reserves get, this also becomes a greater magnet for you to jump on opportunities so that you can increase your wealth plan over time. So if we add all those up, it'll say that we've got $50,000 of total liquid assets. Now, follow-up question, we want to make sure these assets are working hard enough for us. Now, if I were to ask a room full of investors, hey, I've got an investment for you, it pays 3%. Anyone interested in that investment, I can guarantee you not a single hand goes up. Why? Because people always have a criteria for how they invest. 3% is not high enough of a number for me to jump on that investment. I have to look for 8s, 9s, 10s, 12s when I'm talking about investing. So automatically that's off my radar. Now, if I were to ask the same question, hey, what's your criteria for what you'll tolerate from a rate of return perspective with your savings environments? Crickets. Nobody has a thoughtful criteria for where they save and hold wealth. And so one thing you want to do is you want to go calculate, what is the current actual gross rate of return that you're earning on these liquid safe accounts? You kind of have to average those out. Maybe you have a high yield savings account that's not paying you very much, 1%, 2%. Could you find a better location? Cash has no yield on it, but there are some additional benefits to it. So on average, What would you say these assets are earning? And next, what's the minimum gross rate of return you'll tolerate? So if you're going to go put money at a commercial bank, I'm not going to leave money at any bank that's not going to pay me at least 2%. So you can start to get more intentional with where you're going to save and store cash so you're maximizing more of the benefits you deserve. Now, next question is, what would you like to see? What is reasonable and would be exciting for you to see from a rate of return perspective on money that should be very safe, very accessible, very liquid? And the number one answer we hear is about 5%. If I could get around 5% just locked in, this is gross, by the way, I would be happy with where I'm storing my cash. Now, if your cash is earning anything less than that, maybe we need to think about moving it. And the next question I have you ask is, it's not always just about yield for your savings. So what are the benefits that you're receiving with where you currently save and store wealth? And I would say the biggest one that you need to be looking for, like when it comes to saving, the big benefit you want is always going to be liquidity. It's got to be accessible. This is money you have to go get because when emergencies come up, when opportunities come up, you can't say, oh no, I can't go get that cash. Liquidity has to be one of the number one benefits. The next one is safety. These two benefits make up the majority of the qualifications you need to have to call something a savings environment. It's got to be liquid. It's got to be safe. That's why it's called savings. Next one that we look for is yield. Okay, once I know my cash is safe, it's not going to go down in value, it's not correlated to the stock market, nothing like that. Once I know it's accessible, now I want to make sure, am I getting as much juice out of that asset as I can? Is it producing enough yield for me? Next one we might look for is privacy. This is an interesting one. The more success that I've gotten over my lifetime, the more I value this benefit in my wealth plan. And, over a decade ago, privacy was not that, it wasn't on my radar. Today, it is absolutely on my radar. Protection, asset protection, privacy, these things are very important to me. And so think about this from a privacy conversation. The reason you might hold actual cash under your mattress or in your safe at home, it's probably one of the most private sources of cash you would have. Nobody really knows you have this. Now, you give up yield though. You don't open up your safe and there's $50 more that were created there overnight, right? So you're going to give up other benefits. It's very safe to hold cash. It's very liquid, probably the most liquid. It's also very private, but you don't ever get any yield. You could go to a high yield savings account and you would get a higher rate of return. It's still liquid, it's safe, but you're going to lose the privacy benefit. Another big one that people look for is inflation protection. A lot of people like buying gold and silver because they think it's a good hedge against inflation. So notice here with all those environments we just talked about, high yield savings accounts, cash, treasuries, CDs, life insurance, cash values, almost all of those offer some trade-off to benefit. And what we're trying to accomplish here is, do we have the right location of where we're going to be saving our cash reserves so that we're maximizing all the benefits that we deserve? So let's take a look at this. Let's talk about where were you saving more than 10 years ago when interest rates were close to zero. Now, if we take a look at this, let's go back in time, 25-year-old Kyle. This is when I started buying life insurance. And one of the reasons why I started buying life insurance well over a decade ago is because the yield in 2009 all the way through 2017 up into 2020, there was no yield for 10, 15 years. That is a really long time to have cash sitting somewhere that didn't earn anything. You basically lost a decade of potential growth on any type of savings. But what was interesting is I could buy life insurance back then, and life insurance has a guaranteed net, call it 3 to 4% return. Now keep in mind, that's net. We're not even talking gross. And I'm going to show you how to calculate that in just a minute. So this red line is about where I'm going to get with whole life insurance minimum. That is a 4% gross. Whole life will earn about 3 to 4% net, one of my favorite benefits about it. All the white space below that, look at all the years that whole life insurance would have not just beaten, but completely demolished most other savings environments. And that's just one of the benefits. And so, in the past few years, 2024, 2025, you could find some high yield savings accounts recently that are paying 5, even 6%. but those will fluctuate. They're not always locked in for a long period of time. So you might be able to capture some yield for a few years. Once again, is that juice worth the squeeze? Is it worth having more noise in your life, always trying to run around trying to find these little environments to move cash around to be more efficient? And that answer is maybe. So option one that I think everyone's doing, everyone's holding money in some type of bank account. You have to, me included. The difference is, am I earning about 0%, or can I find other short-term places to store really liquid cash so I can get a higher rate of return? Option two that I think needs to happen as well for anything long-term, I'm going to get a whole life insurance, absolutely, for the long-term benefits. Now let's take a look at a few of these banks, because this is really interesting. This was a few years ago when we built this. But a couple of years ago, you could find these banks, Capital One, American Express, Basque Bank, and they were all paying 4.25%, 5% annual percentage rates on their savings. These were pretty good times to be saving money with a bank. Now, what's interesting about this is these banks will offer us products like high yield savings accounts, but they store a large portion of their cash reserves in life insurance contracts. All of those banks that were offering those high yield savings accounts, this is the dollar amounts that they were holding in cash reserves inside a whole life insurance. And those aren't even the big players. Here's the big players. Bank of America, 24 billion, Wells Fargo, 19 billion, Chase Bank, 12 billion, all bank-owned life insurance. Banks love to put a portion of their long-term savings in life insurance because of the benefits they get from that. It's just a very efficient environment to be saving in. You have to ask this question. Here's what we commonly hear about whole life insurance in the big wide world. It's got a low rate of return, it's expensive to own, it's the worst investment of all time. And one thing you have to understand is banks are not buying life insurance because it's an investment. They buy it because it's one of the greatest places for them to maximize benefits of where they store cash reserves. So life insurance is not an investment. And if you can't stop looking at it as an investment, you'll never end up appreciating how powerful of an asset this is, but it's got to be placed in the right sequence in your wealth plan, which has to be at the foundation. So banks are not storing their savings with other banks. Isn't that interesting? They store their savings with life insurance companies. And you'll learn about this in this book, Becoming Your Own Banker by Nelson Nash. Banks want life insurance for a number of economic benefits that they receive. So let's jump into that and really understand why. Banks love life insurance because they're going to get these 8 benefits on your screen, and you will not find these 8 benefits in any other singular location. And if you want to read a great book about this, you can get a copy of The Pirates of Manhattan by Barry Dyke. It's one of the books up here. Barry Dyke has done more research and investigation into who's been buying whole life insurance, who's holding it, why do they buy it, than just about anyone else that I'm aware of. So if you want a good read, it's a frustrating read, I'll tell you that, because you're going to feel like you were lied to your entire life. And these massively wealthy companies and corporations have known about this and don't necessarily want us to know about it, because then we would put more of our money into private contracts with insurance carriers than we would with banks and Wall Street. And so these benefits, guarantees. So you get a contract for the rest of your life that your cash will always be compounding. It's always liquid. It is private. There's a flexible loan provision, which is one of the greatest features of the policy, that you can borrow against it and not interrupt growth. Unstructured loans, completely private. You get a wonderful death benefit, which is one of the main reasons you want to buy life insurance in the first place, is because you have a 100% chance of passing away. So imagine if a commercial bank said, hey, if you store cash with us, we will give you a guaranteed interest rate forever, and it's a very competitive yield. Your money's always liquid. There's no penalties to use it. It's very private. No one will know about this, including the IRS, because this is not an investment. It's a life insurance contract, right? And if you pass away in 5 years, we'll pay you $1 million to help support your family. Like, what a wonderfully beneficial asset that is. Now, banks offer us products like CDs, checking accounts, savings accounts that give you some safety. They give you some liquidity, and maybe there's some yield, but you're not really getting any other benefits there. And so when we really jot this down, okay, add up all the liquid safe assets you own. What are the benefits you're getting? Then how much cash value do you own? And in that cash value contract, that whole life insurance contract, these are the 8 benefits you're getting. And the best part is you get them permanently for your entire life. And once you see this, you'll never be able to unsee this ever again. People get the surface level education around whole life insurance. And I think people miss it because these benefits on the screen, privacy, guarantees, liquidity, a death benefit, all of these benefits will come into play at very different points in your life. So when I was 25 years old buying whole life insurance, I was buying it because it had a really great yield when I couldn't find it anywhere else. It was guaranteed to get better every single year I owned it. It was very liquid, and that loan provision, I could not believe that that was real. It was so flexible. It was so amazing. It gave me absolute control in the money game. Those are the benefits of why I bought it. Today, you know, I've got 4 young kiddos, a beautiful wife. That death benefit is more important to me than ever before. The privacy of how much cash value I own, how much death benefit I own, that privacy and that death benefit, those are some of my most important and favorite benefits I get today. Those were not really on my radar, you know, over a decade ago. So it's interesting how as you grow in your life and you're moving towards this max potential version of yourself, these benefits are going to come into play at very key moments for your life. And this is why I would say whole life insurance is the toughest asset you can own foundationally, because you will not find these 8 benefits in any other singular location. Now, the last question, the competitive yield. This is one of the benefits that I think is the most misunderstood benefit of quite possibly the most misunderstood asset ever, which is whole life insurance. People do not understand life insurance, and that's why education is so important. Once you understand that this is nothing more than a very beneficial place to store cash reserves that comes with more benefits you're ever going to find, the next question is, how do you understand the yield? Because we hear things in the big wide world like, whole life insurance earns around 3 to 4%. That's such a low rate of return. Why would I put money with whole life insurance if I can invest and get 8%, 12%? Well, now we're having 2 different conversations. That's an investing conversation. This is a savings environment. So you got to compare it against other liquid safe assets. And one thing you got to understand about insurance policies is all the returns are net numbers. So this is called a funding illustration calculator from Truth Concepts. Any insurance agent that's not using this, I think, is at a huge disadvantage in the industry. If you're using an insurance agent who's not using Truth Concepts, please encourage them to go to a training and get educated, because the math behind the benefits of life insurance is so vital. And so we've got a 40-year-old female here who's going to say, hey, I'm going to save $20,000 a year, and I'm going to put that into a whole life insurance contract, okay? So you've got the annual cash value increase. This is what's happening on a year-over-year basis. So you can see here in the 5th year, she's going to put in $20,000. The policy grows by more than $20,000 in that year. This is like running a business. In that year, I've got a business that's guaranteed to produce more than what I'm paying into it. The expenses are fixed. That's the premium. But the cash value growth each year is going to go up. This blue column is the net cumulative cash value. So that's what I have in available equity, if you will, total. And then over here, the purple column is the death benefit as well. And if we look at this over a 40-year time frame, she put in $800,000 and it grew to $1.8 million in cash value growth. Now, if you take those premiums, $20,000 a year for 40 years, and then in order to earn $1.8 million at that same exact time, what this calculator is showing us up here at the top is you would need an internal rate of return of 3.74 every single year for 40 straight years, never missing a beat, to have that type of return. So this is where people hear whole life earns 3 to 4%. This is where that's coming from. If you take this over like a 40-year time frame, that's the equivalent rate of return you'd need to produce this, okay? Now, keep in mind, this is net. So I'll give you a great example. I was at Chase Bank a number of years ago, privately financing a truck through our family banking business. And so I took a policy loan. It got transferred to the bank. I went and got a cashier's check to go privately buy the truck, and then I financed it to a sibling. And while I was there, they had this advertisement for a CD, a certificate of deposit at Chase Bank. Now, they said the CD is paying 5%. but you had to put a certain amount of money in it. So I asked him for some info, and I found out that the CD that was paying 5% gross, there was a 1% management fee on it. So automatically, they're going to charge you 1% to just manage it. So if we look at this calculator now, what this is showing us, if we want to compare the net return of life insurance to the gross return of another liquid safe asset, that CD would need to earn 4.79 every single year for 40 years to be equal to the cash values in this insurance contract. Now, the CD was for like 2 years, 3 years, maybe. It wasn't locked in for 40 years, I'll tell you that. The next thing is there's taxes on that CD, savings accounts, treasuries. So we have to factor that in as well. If I'm in a 30% tax bracket and there's a 1% management fee on that CD, the alternate interest rate I would need on that CD for 40 straight years to match, not be better than, to be equal to the life insurance cash value, would be 6.87% every single year for 40 years. I will tell you, there is no other singular asset out there that has the benefits of whole life insurance, and it is so hard to beat from a competitive yield standpoint. Once you see this, you will never unsee this, and this will become one of your favorite assets to place at the foundation of your wealth plan. So if you want to see how this would work for your wealth plan, can this asset at your foundation get you from where you're currently at to where you want to go in the future with less time and less risk? Reach out to me, book what's called a path of money analysis. I'm going to show you how money is moving through your life and help you identify what next best moves are for you. And as always, choose truth over trends, education over products, and people over profit.